I think I'm channeling Chuck Prince from years ago, when the bull market was going crazy, and he said, you've got to dance when the music's playing. I'm not saying anything quite that aggressive or bullish, Melissa, but, it's hard to feel too bad when the market's making new highs and stock prices are making your portfolio look really good. The valuations, however, if you're going to look at it on a nuts and bolts basis based on the earnings and earnings growth and top-line growth, it's okay. But the multiple that we're paying for these current prices is historically at the higher end of value. It's full value. Things that are expensive can become a lot more expensive, and the momentum is still positive, so enjoy it. But I think you have to look also at your portfolio and begin to maybe trim some things that have become too expensive and invest in things that haven't done well. Hit them where they ain't. Buy low. Sell the highs. Buy the lows. In general, the market is not low, so be careful.
Michael, can you get more specific on that? Because, look, what you said off the top about dancing while the music's playing is the fear of some that there's no fundamental justification for being in the market. So tell us, whether it's individual stocks or the market overall, why you think it's wise to have exposure and where.
Right. Well, okay. So while the market is fully valued, I think it always makes sense to buy stocks and things that are going up and are going to be able to continue to earn. So, and just because the economy is creeping along slowly and the market's melting up, I mean, this is the most hated bull market in history. But I think if you look, talk about some of the things that Bob Pisani was saying, you can look at the energy stocks. I think you can look at the healthcare stocks one by one. There's a group that is perennially hated whenever one group of politicians says we're going to get those guys, and ultimately they don't go out of business and they end up okay. You can take a look at some of the financial stocks, even in this rate environment, that are selling close to book value. There's value out there, and I think you're going to look at some of the names where you say, oh, I don't want to own that today, and then a year from now you look back and say, you know what, we should have known better. There was no real there, and guess what? Boeing's still going to be in business.
Beyond valuation, Bob Pisani, one thing that seems to be emerging out of earnings season is the company's ability to raise prices either to offset rising costs, such as wages or raw materials, as we saw in the case of Caterpillar, or oil, for instance, as we saw in CSX. I mean, Procter & Gamble, Coca-Cola, many companies have said they've been able to raise price. And shouldn't that be comforting for investors?
It certainly is. I mean, remember, the main determinant, rising earnings is the main determinant for stock prices, but margins really are the most important thing. And we've been about 11%. The S&P's margins are about 11%, 10.5 to 11 for several years now. Those are close to historic highs. And if they slip, that's going to be a major problem. When you have pricing power, you can raise your prices even though you have higher costs. That means the margin does not go down. So maintaining that margin is a critical part of this whole thing, and I think that's certainly very encouraging for everyone.